Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, your Dr. Finance. And here we are going to I'm going to start talking about behavioral corporate finance. I told you before, finance has two big areas. One is asset pricing. Capital Asset Pricing Model, CAPM. That was big. Portfolio theory and then CAPM was big in your financial management. That's asset pricing theory. Capital Asset Pricing Theory, CAPM, AP, investment. How do rational investors or irrational investors make money? Can we predict the returns of these assets, right? Efficient market hypothesis says no, but we find yes, behavioral finance, guys. Return prediction kind of things. That's asset pricing. Hedge fund, mutual fund, the institutional investors and individual investors. Yeah. And derivatives and regular, plain vanilla stocks and bonds and things like that, right? How do we invest? And then we maximize our returns under the constraint of minimizing those risks. Okay? Constrained maximization, optimization problem that we solve, right? Now, asset pricing has two approaches. One is neoclassical and the other is behavioral. I talked about this part, right? How does it get affected by market sentiment, the bubbliness, right? The other part of finance is corporate finance. Again, here we have two different perspectives, which is neoclassical economist rational behavior versus irrational behavior coming from psychologist or behavioral finance guys like myself, right? Corporate finance, what do we study over here? This is a game. This is a series of games or a bunch of games played between those insiders and outsiders of corporations, companies, right? So the insiders are the CEOs or CFOs who have, who is decision makers with the highest degree of information. They are the industry experts. They have the key information. 이재용 형님, guess how much he's able to talk to important persons with key information. I heard from somebody riding the same airplane with him, and they said, 이재용 once was calling directly to the Google CEOs and then all those high-level guys that we just hear about through the news media, but he can directly talk to them. Okay, he talks to them, right? And then, has the key information, secret. Okay? They are the insiders of the companies. Okay? Expert knowledge, expert information, everything is there. Outsiders, like you and me, we don't know what the hell is going on in that semiconductor industry. There's no influence on that. We are outsiders, right? But we put our money as a shareholder and then delegate our decision making to the CEOs. 이재용, you do your best to maximize our shareholder value, please. Okay? But there is information asymmetry between me and 이재용, right? The insider versus me, outsiders. We play the games, some games. What kind of games it is, it depends on our interpretation. It depends on the context we talk about. Now, corporate finance, right? We say we have three big decision making in corporate finance. What are those, right? Let me remind you of this. It gets back to your financial management, right? So, first, we look at the company's balance sheet, which is balance sheet. It doesn't stand for bullshit, right? It's a balance sheet. This left-hand side, you have asset and debt and equity, or liabilities and equity, but let's say debt, right? Because we care about those interest-bearing financing tool, debt. Right? Not all part of the liabilities we care about it, right? Deferred tax liabilities, who cares? Yeah, it's a big chunk. Yeah, CPA care about it, but that's for CPA. Anyway, so that's that. And then First decision is about this asset side. Assume that you have enough money. Somehow you raised capital, and then how would you invest so that you would maximize the shareholder value? That's the key goal over here. Now, what do you mean maximizing shareholder value? By investing wisely. Well, investment rule, the most important investment rule was what? NPV, net present value, positive and bigger would be better, right? So NPV or even NPV, right? Maximizing NPV, preferable. Make sense? That was our key decision making, positive NPV. If you choose to invest in positive NPV, what happens? Well, with the announcement, your asset value increases as much as your NPV. And that, okay, asset side increases, which means the balance sheet has to balance each other out. Wonderful property. But the thing is, debt does not increase. It's just fixed over there. Then what should increase? The residual, which is equity. So the shareholder value or market cap will increase. Okay, that's this guy. Equal amount. Positive NPV gets into the stock price. Positive response. Okay, don't take this as decreasing it. It's just expanding it. Okay, so the shareholder value will go up. Stock price jumps up if your CEO makes a wise decision. Okay, that's this guy. For your lifetime, you should remember this one, okay? Until we die, right? We just have to remember positive NPV, biggest NPV, maximizing it, shareholder value. It goes together. That's investment decision making or capital budgeting decision making. What do we do with this money in the asset side? That's one key decision making. The second key decision making is about capital structure. Previously, we assumed that we raised capital somehow. But the second question is about precisely how. Okay? Debt and equity mix. Let's say Samsung Electronics is decided to go into foundry business. Foundry, well, it's about chip producing, microprocessing, the semiconductor producing, right? Like this memory chip or whatever USB, right? But foundry is about more flexible, order-based, flexible design, chip design. Small quantity, but diverse designs, right? You can satisfy. So TSMC has been doing that, but Samsung has not been doing that. But right now, they announced that they will start to do it from now on. Every year, they're going to invest like 30 billion, not 1 3, but 30 or even 31 billion US dollars worth, right? Every year over the next 10 years. Huge amount of money, all right? So they're going to do foundry business, expanding it. And the question becomes, how would they raise those $31 billion every year? Should they borrow from the bank? Or should they raise equity or issue stocks, do seasoned equity offerings, right? 유상증자, should they do it or borrow from the bank? Alternative to this borrowing from the bank within this is issuing corporate bond. So fixed income security. Should they issue and raise capital to support those foundry or this guy? That makes difference. Okay, that's the second decision making. We're going to talk about this capital structure decision more detail later on. So wait for that. The second decision, right? The third key big decision in corporate finance is what? Well, it goes to your income statement. Income statement, you start with revenues, right? And then all the cost you subtract, and then interest expense you subtract, and non-operating income and expense, You add and subtract, and then finally you subtract the tax. Tax. Finally, you get into net income. Of course, the company could make net loss, unfortunately. But let's say you have made net income. Then what do? It's time to party, distribute among shareholders. What do you mean, party? You got net income, positive amount. A part of it should be reinvested to your equity, retained earnings, in the form of retained earnings. But I said party time because a part of it you can distribute as dividend. Shareholders have every reason to party. They took the risk and they finally got the return in the form of dividend. So cash it out partly. That's their right. Okay? So that's how much should we reinvest and how much should we pay back to the shareholders. That's the third key decision making of corporate finance. Very important. How would you treat your shareholders, right? So those three are very important. Capital budgeting, capital structure, and then payout policy. Dividend payout. Alternative to dividend payout is what? Stock repurchase, right? Repurchase, right? Instead of paying out the cash, buy the traded stock and then, burn it, right? The number of shares outstanding decreases. So the remaining share prices go up. Mathematically, it has to happen that way. So the existing shareholders, they like it because their share price goes up with the repurchases, because the denominator goes down. Make sense? So that was the idea of three key decision makings, right? The thing is, because of the informational symmetry, all these kind of decisions can work as a signal between you and me, the CEOs, and ourselves, right? And the game playing happens. Neoclassical economics, right? They assume all these players, the CEOs and then the outsiders, are rational utility maximizers. No mistake, on average, right? And then mathematically, their behaviors will be modelable or tractable, right? Or analyzable with closed form solution kind of things, right? But behavioral finance guys, we say, well, come on. Not everybody is rational all the time, at least, right? The CEOs can do crazy things, and investors can do also crazy things as well, right? If you remember your boss's behavior in your internships, right? Are they always behave in rational manner? And you say, no. Think about your parents. Are they always behaving in rational fashion? And yourself, right? Are you always rational? You're not. These are the CEOs are the same person, human being. They have psychological biases. And how does that bias affect those game playing? And then what's the consequence to the shareholders? That's what we are interested in. Okay? Let's see what happens when one party in the game is irrational. One is the shareholders, right? When those investors are in a bubble, in a high sentiment, oh, they're going crazy about the stock and this kind of things. And then what does the CEOs do? In that situation, we are going to assume only the shareholders are, or investors are irrational, but the CEOs are rational, taking advantage of it. That's the first situation we're going to talk about, and we're going to finish that in rather short manner in this video or in the next. The second situation is when the CEO is irrational, crazy CEO. Okay, not the crazy, but the overconfident CEOs. And another part is narcissistic CEOs. And another part is masculine-faced CEOs. That's my major, right? And this kind of things, right? And then the CEOs with self-attribution bias, the language pattern. That's my major, my research as well. Okay, so this kind of situation, how does he or she affect the shareholder value? That's what we are concerned about in behavioral corporate finance. A lot of it goes together with the strategy research, the management strategy. Okay, but we corporate finance guys, we are the pioneers in quantitative way. Okay, how to quantify those psychology? We pioneer those ways, and then those pioneering ways of this measuring those biases helps in fintech as well, because measuring the biases of the CEOs, let's apply the same technique to the retail investors like you and me. Why not? Of course, there could be some biases because of the small group of leaders versus general public. How much generalizable is it is still in question, but it opens up the question. Oh, maybe it is suitable, right? Or applicable. Maybe we could use it to our fintech services. Maybe we could expand our fintech services using the research result over there. Language pattern of the guys shows up. Okay? Language is a mirror of the mind. And let's look at your Katok messages, text analysis, and find out more precisely about you. How much narcissistic are you? Yeah, depending on that, we can price the loan differently. If you are more narcissistic, chances are you are more likely to spend more, explicit or more vividly, or the more spending crazily, right, to draw more attention, which means you may suffer more bankruptcy risk. So that if you borrow money from my bank, I will charge you higher interest rate just by looking at your text messaging. We can do that. Yeah, why not? And this kind of big data approach is widely applicable and is widely explored in this research. That's why it is so interesting and exciting to do this research, by the way. Yeah. Anyway, so the first thing is about the irrational investor approach, right? This study shows rational managers act in the presence of, irrational investors, and then we're going to talk about market timing and catering, about the equity issues, right? And the name changes and that kind of things we're going to talk about. And the irrational managers approach, well, a bunch of them, so much is going on. There, we're going to assume the investors are rational, rather. Some of you may question, what about both parties are irrational? We don't model it. We call it crazy, right? So that's that, right? Extremely difficult to model, in a nice way of saying it. So that's it, right? Here, before I go into the market timing theory of capital structure, why don't I cut it over here and start from the next video, because it is already 18th minute. So I hope you gave some nice summary or overview of behavioral corporate finance, right? How much it is applicable, why is it promising from fintech perspective, right? Why is it so interesting and sexy? Yes, an interesting, exciting field. Yes. So let's go. Thanks for watching until now.